I'm John Hanna for CDTV.net, and we have Dirk van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk.
Hey, John, how's it going?
Good, good, good. And yourself?
Oh, not too bad. It's sort of cold and frosty here in Dayton, but aside from that, things going okay.
I guess we got some of your snow ready because we have some snow here in New York City.
Yeah, we got about 4 inches or so.
Yeah,
Nothing quite like Minneapolis, but
yeah.
still white on the ground out there.
Yeah, I mean, it's not that major. It's just a little bit of some like dusting here in New York, but it's not that big of a deal.
Yeah.
So, Dirk, what do you have for us today?
Well, the most significant number that came out today was the retail sales report. And it sort of confirmed what we saw, a week ago when a bunch of the big chain retailers came out and were by and large reporting better than expected sales. But even given that the expectations were pretty decent going in, we handily beat them. Total retail sales, and this is a very broad measure of retail sales. It's not just at the malls. Rose by 0.8%, which is well ahead of the 0.5 expectation. Now, that's a big slowdown from October when total sales grew 1.7%. And the further good news in the report was that October was revised sharply higher. The initial October report was a gain of 1.2%. So, a revision up to 1.7% is, eye-opening, and definitely shows that the consumer seems to be back on track, even though the consumer sentiment type numbers are still very depressed. And that's one of the problems that I have with consumer confidence, consumer sentiment type numbers, is that they don't really line up with what consumers actually tend to do. Now, a big part of it is what's going on with auto sales, which obviously big ticket items and amount to are a big part of overall retail sales. And they were actually relatively weak in November, falling 0.8% from October. But October was just a gangbuster month, which was up 5.6% from September. So, given that they were starting off from a much higher base, not really all that bad. On a year-over-year basis, auto sales are up 12.5%. That's a very big gain. And, unlike, say, the September or October numbers, which were really boosted by what happened a year ago with the Cash for Clunkers program expiring, so you had that massive hangover. That hangover effect was mostly gone by the time you got to November. So if one strips out the auto numbers, you really had a monster month with sales up 1.2% for November. That's a nice acceleration from up 0.8% in October. And October ex-autos was also revised sharply higher, literally doubled. It was previously reported as up 0.4%. So the consumer does seem to be back on track based on this data. And, if we dig down a little bit deeper to where the things are growing, to some extent, things are a little bit overstated on the ex-auto because the biggest monthly rise was at gas stations, up 4%, and that's on top of being up 1.3% in October and up 9.0% year over year. And I don't think that that's really a case of us driving that much more, in other words, more volume of gasoline, and it certainly isn't because everybody decided to buy, a whole bunch more 44-ounce, big Cokes than they did last month, or hot dogs off the rollers, or anything, stuff like that. That's strictly a reflection of rising gasoline prices. But, even still, the 1.2% ex autos is a very healthy rise. But in some of the other sort of more discretionary areas, well, they were sort of mixed, but, clothing sales, for example, gained 2.7%. That might be a reflection of colder and more seasonable weather that's gotten people back into buying some clothing. And, clothing is a semi-discretionary item. It's not like going out and buying a new sofa, but, it's not, picking up some pasta at the grocery store either. It's deferrable, but not endlessly deferrable. Sporting goods and hobby shops posted a 2.3% rise on the month. General merchandise had a very healthy 1.3% increase. So those sort of things are looking pretty strong. But there's some other discretionary areas that were definitely disappointing. One is furniture sales, which were down 0.6 or 0.5% on the month, and that comes on top of a 1.2% decline last month. And year over year, furniture sales are only up 0.6%. That's very much in the disappointing side, and that's a very discretionary, big ticket type item. It also includes appliances. So that's a little bit of a worrisome sign there. But then again, usually one of the biggest catalysts for people buying new furniture and appliances for that matter is when they move into a new home or a new for them home. And both existing and new home sales have been exceedingly weak of late, and so that's probably one of the reasons why furniture sales are so weak, both on a month-to-month basis and also year over year. I mean, by far the weakest area. The other area that was quite weak is the electronics stores, and we definitely saw that today with the Best Buy earnings report, which was exceedingly disappointing. And some of that might be market share being lost to some of the the Walmarts and Targets of the world. And electronics is always an area where prices just naturally tend to fall. And the retail sales report is not adjusted for price changes. It's adjusted for number of days of the month and that sort of stuff, but not for prices. And for electronics, that tends to hold down the growth as opposed to, say, gasoline, where it was mostly just a price story going on. But it does seem to indicate that people are buying fewer flat screen TVs and stuff like that over and above the effect of just prices tending to come down in electronics. Electronic stores on a year-over-year basis were the second weakest area, up only 0.9%. Most of the other areas are up, sort of solidly in the mid-single digits area. So, by and large, there are a couple, sort of warning signs in some of the discretionary areas, but other discretionary areas are doing quite well, particularly if you look at it on a year-over-year basis. Overall, I'd say this was a pretty encouraging report, showing that the consumer is starting to actually show some confidence, even if the numbers that they say in the consumer's confidence surveys are still extremely depressed. So, and consumer spending is 71% of the economy. So this is kind of an important report, even though 2/3 of that the consumer spending is actually on services, and a lot of services really don't show up in the retail report. But still talking about a pretty substantial chunk of what's going on in the economy here, and the combination of a much better than expected report plus huge upward revisions to the prior month really does sort of indicate that we're going to have pretty decent real GDP growth in the fourth quarter. Combine that with the good trade report that we got last week, and you're probably looking at something on the order of 3.5% growth in the fourth quarter, up from 2.5% in the third quarter. So definitely, it seems like we're starting to gain some traction in this economy. Don't necessarily think we're home free. We've got a long ways to go, but this is definitely a very encouraging report.
That's Dirk van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York City.